Ever wondered how the world's wealthiest individuals grew their wealth exponentially? Well, the secret isn't buried treasure or a magic lamp. It's something far more accessible yet often misunderstood: investing. Imagine investing as a seed. You plant this seed in the fertile ground of the financial market, and with time it grows, producing a bountiful harvest. That's the power of investing. It's not about instant riches, but rather it's about nurturing your resources, making smart decisions, and watching your wealth grow over time. Investing is the art of putting your money to work. It's about letting your hard-earned cash generate more wealth for you, rather than just sitting idle. It's the tool that many have used to build empires, secure futures, and change their lives. So, what's stopping you from stepping into this fascinating world of investing? The journey might seem daunting, but remember, every great journey begins with a single step. Before we dive into investing, let's understand how it differs from saving. You see, saving is a secure way of storing your money, often in a bank, where it earns a modest amount of interest over time. It's like a safety net, there for you in case of emergencies or short-term goals. On the other hand, investing is about growing your wealth. It involves putting your money into assets like stocks, bonds, or real estate with the expectation that, over time, they will increase in value. This growth potential is what sets investing apart from saving. While it comes with its share of risks, investing can offer higher returns compared to the modest interest earned from saving. It's like planting a seed and nurturing it over time. With the right care and conditions, that seed can grow into a towering tree, providing you with bountiful fruits. Now that you understand the difference, are you ready to take the leap into investing? Just as there are different strokes for different folks, there are different types of investments to suit different people. Now let's take a closer look at these investment types, shall we? First up, we have stocks. When you buy a company's stock, you're essentially buying a piece of that company, becoming a shareholder. Stocks have the potential for high returns, but they also come with a higher risk compared to other investment types. Remember, with great power comes great responsibility. Next on our list are bonds. Think of bonds as a loan you're giving to a company or government. In return, they agree to give you back your loan at a certain date, with interest. Bonds are generally considered safer than stocks, but the potential returns are usually lower. Then we have mutual funds. These are a mix of stocks, bonds, and other securities, all wrapped up into one neat little package. With mutual funds, you're spreading out your risk, as your investment is diversified across a range of different assets. It's like having your eggs in different baskets. Last, but certainly not least, we have real estate. This can be anything from buying a house to rent out, to investing in a real estate investment trust, or REIT. Real estate can provide a steady income stream and potential tax benefits, but it also requires more hands-on management. Each of these investment types has its own set of pros and cons, and the best one for you will depend on your financial goals, risk tolerance, and investment horizon. You might be more inclined towards the high-risk, high-reward nature of stocks, or you might prefer the slow and steady approach of bonds. Perhaps you want a bit of everything, in which case mutual funds might be your cup of tea. Or maybe you're a real estate mogul in the making. Remember, the key is to diversify your investments. This way, you can spread out your risk and potentially increase your chances of making a return on your hard-earned money. After all, variety is the spice of life. And in the world of investing, it's also the spice of a well-balanced portfolio. We've discussed some traditional forms of investment, but let's now dive into the world of cryptocurrencies, a modern and often misunderstood investment option. Cryptocurrencies are digital or virtual currencies that use cryptography for security, making them difficult to counterfeit. They operate independently of a central bank, which makes them immune to government interference or manipulation. The most well-known cryptocurrency is Bitcoin, but there are thousands of others out there, including Ethereum, Litecoin, and Ripple. These digital assets can be bought and sold on various online platforms and have the potential for high returns. But be warned, the cryptocurrency market is notoriously volatile, which means prices can skyrocket one moment and plunge the next. This makes them a high-risk investment. If you're considering investing in cryptocurrencies, it's crucial to do thorough research and understand what you're getting into. Some people see cryptocurrencies as the future of finance, others as a speculative bubble. Either way, if you decide to dip your toes into this digital currency pool, remember to only invest what you can afford to lose. After all, the golden rule of investing is never to put all your eggs in one basket, and this holds true for cryptocurrencies as well. So you've chosen to take the plunge into the world of investing. Pondering where to commence? The initial stride involves defining your financial aspirations. Are you investing with retirement in mind, to purchase a dwelling, or maybe to secure funds for your offspring's education? Recognizing your investment purpose will assist in shaping the ideal investment approach tailored to your requirements. After laying out your financial targets, it's time to dive into some due diligence. Investing isn't about rolling the dice, it's a well-thought-out risk. It's crucial to comprehend where your funds are being allocated. This involves familiarizing yourself with diverse investment options, including equities, bonds, mutual funds, and real estate, each with their unique potential yields and associated risks. Next, we delve into the concept of risk tolerance. This is a gauge of the financial risk level you're at ease with. Some folks are adrenaline junkies, willing to potentially forego money for the prospect of substantial returns. Others lean towards a more cautious approach, favoring investments with modest returns and minimal risk. Your risk tolerance will steer your investment selections. Remember, there's no universal right or wrong, it's about what resonates with you. With your objectives outlined, your preliminary research complete, and your risk tolerance identified, you're primed to devise an investment strategy. This is a blueprint delineating what you're investing in, the amount invested, and the investment timeline. For instance, you may choose to allocate 20% of your monthly income into a blend of equities and bonds. Alternatively, you may opt to invest a substantial amount into a real estate investment trust. Your strategy should be molded to your aims, your risk tolerance, and your financial standing. Crafting an investment strategy may appear overwhelming, but keep in mind it's not immutable. As your circumstances evolve, so should your strategy. You might secure a job advancement and decide to invest a larger portion. Or you may become a parent and decide to inaugurate a college fund. Life's unpredictability is a given, and your investment strategy should be adaptable enough to evolve with it. With your roadmap in hand, you're now prepared to embark on your first investment journey. Welcome to Scene 6, Investing Pitfalls to Avoid. The journey of successful investing, like any expedition, has its rough patches and hazards. Let's explore some prevalent investment missteps that can disrupt your financial trajectory. The first hazard is the failure to diversify. Perhaps you've come across the adage, "Don't put all your eggs in one basket." This advice is particularly pertinent to investing. Diversifying your investments over multiple assets diminishes the risk of significant loss if an investment does not pan out. Another frequent error is attempting to predict the market. The concept of buying low and selling high is appealing, but it's extraordinarily difficult to reliably anticipate market variations. Even the most astute investors struggle to precisely foresee the stock market's fluctuations. The better approach is regular, steady investing, irrespective of market status, as this often delivers long-term returns. The third hazard to sidestep is allowing your emotions to steer your investment choices. The world of investment carries a healthy dose of ups and downs, and it's normal to feel joy or despair in reaction. However, making impromptu decisions based on these feelings can lead you on a dicey route. Instead, a calm, logical attitude can aid you in staying on track during tumultuous times. Finally, lacking a precise investment target or plan is an error that can be very costly. Without a distinct goal and strategy, it's all too easy to forget why you started investing. Whether your aim is retirement, purchasing a new home, or funding your child's education, having a concrete, quantifiable objective can keep you focused and driven. To summarize, evading these common investment hazards, neglecting to diversify, attempting to time the market, letting emotions rule your choices, and lacking a distinct investment aim can considerably enhance your likelihood of financial prosperity. Remember, investing is a marathon, not a sprint. It entails patience, persistence, and a meticulously planned strategy. Steering clear of these hazards can set you on the road to success. Rome, a majestic metropolis, was not erected in a single day, just as a rewarding investment portfolio cannot be amassed overnight. This is a principle deeply rooted in the soil of financial growth. Often quoted is the virtue of patience, but in the landscape of it transforms into an irrefutable essential. The journey of investing is not a brisk sprint. It's a test of endurance. It's not a race for easy riches, but a strategic play to bolster your wealth steadily over the course of time. The hurried ones, entranced by the charm of gains, often find themselves on unstable grounds. But the ones who master patience, who withstand the temptation to buy high and sell low, who comprehend that it takes time for financial seeds to bloom, these are the ones who harvest the gains. Investing is a game of foresight. It's about sowing a seed today and relishing its shade years into the future. It's about acknowledging that the power of compounding requires time to weave its spell. So, are you prepared to commence your journey of patient investing?